So hello, welcome back everyone to part 3 of lecture 4 for Finance2. So now I'm going to talk a little bit about the valuation of Spotify. So this is very back of the envelope, so very quick and dirty. Treat this more as a kind of preliminary to how companies in general value in the field than taking this too seriously. I think by the end we'll see that we come pretty close to how investment banks do it. And I promise you that the techniques we'll talk about today are very close to what investment banks use in practice. But of course, the details matter, and because the details matter so much, you have to be careful if you really continue in this field. But most of these techniques, I assure you, this is more or less the strategy that is followed by most companies that value any type of company. So let's start with Spotify. So Spotify, this music streaming business, I think familiar to most of you. And on April the 3rd, 2018, they did a direct listing. So it's not entirely an IPO, because in an IPO, typically a company itself also sells shares. Here there was a direct listing, so that more or less the shares of Spotify became public. So that the early investors of Spotify could actually sell their shares and cash out a little bit, maybe diversify their portfolio, which is so important, as we said before. So no issuance, no underwriters, simply just selling of the shares of Spotify. But of course, we can ask ourselves, hey, for how much should these investors sell their shares? If they sell it for too much, if they put the price too high, they won't sell any shares. If they put it too low, then maybe they could have done better. So let's see if in a back of the envelope type of calculation of, let's say, 10, maybe 15 minutes, maybe we can come pretty close, and let's see. So if we think about any businesses are usually assumed to be ever-lived. So we don't really know when Spotify will ever cease to exist. So the best way to deal with this is to assume it lives forever. Of course, it could be that in, let's say, 10 years, Spotify is bankrupt, and that would be a problem for the perpetuity calculation, because, well, then all those values from year 11 on, we discounted, even though we shouldn't have discounted it, but because further into the future you discount by a lot higher of a discount rate, those will matter less than the values we find up front. But for now, well, the best we can do is assume that Spotify is ever lived. So what do we need to calculate the perpetuity? Well, value right now is the cash flow next year over discount rate minus the growth rate. So yeah, we can start somewhere. So let's start by estimating the discount rate. First of all, what model will we use? Well, let's do what we did so far and focus on the capital asset pricing model. So capital asset pricing model, risk-free rate plus beta times the market risk premium. And let's start with the risk-free rate. So let's use treasury rate, but what maturity shall we use? And for that, I'm going to ask you, which maturity should we use? I'll give you a moment to pause me. And as long as you're on 10 years or 30 years, I think that's fine. So shorter maturities are simply not equal to the horizon that Spotify has for its business. So also not investors that invest in Spotify. They should also have the same horizon when looking at the risk-free rate as they do when they look at Spotify. So we'll take a long horizon. Here I took 10 years because it's simply the most liquid market, so you get the most reliable data. And on April the 3rd, 2018, the risk-free rate, treasury rate, was 2.79%. All right, so let's continue. Let's look at the market risk premium. And for this, I'm going to do it as easy as I can. So I'm going to look at the historical returns. And then take the average historical market risk premium, assume that it also goes for the future. So if I look at the average daily return for the S&P 500, of course this is total return index, so keep in mind we need to include dividends in our returns for the S&P 500. And then it turned out that the average daily return was 10.41% when we annualized the data. Average treasury rate over that period was 5.07%, so now we have a market risk premium of 5.34%. So that seems pretty reasonable. And now for beta, so for beta we can estimate that empirically by doing a type of regression where we take the excess return on Spotify and regresses on the excess return of the S&P 500. Of course, there's a problem because before April 3rd, 2018, Spotify wasn't listed. So what can we do? Well, we don't have any data on Spotify, so we need a comparable. So which company should we use? What do you think? I'll give you a moment to pause me. And here I went with Netflix. So of course multiple answers are possible here. I thought Netflix was pretty comparable because they're both in the streaming business. So business models seem approximately similar. Of course, if you want to be a bit more careful, you take an industry average or maybe take an average from multiple industries, where you look at Netflix's asset beta, but also consider, let's say, something like Virgin Music or so, or another music production company, which is closer to the risk that Spotify finds. For now, quick and dirty, I'm only going to look at Netflix. And then if I put the Netflix daily excess return on the vertical axis, daily excess return for the S&P 500 on the horizontal axis, I find a beta of 0.98 approximately. And here we also have alpha, so Netflix slightly outperformed the market, but it's not persistent, so we're going to ignore that for the rest. Note that I took daily data because, well, then I simply have more data so that outliers won't matter as much in the data unless they are outliers that are kind of like clustered together, like let's say during a financial crisis or so. So if we then think about our balance sheet with on the left hand side the assets, on the right hand side the debt and the equity, then we had an equity beta of 0.1898, but of course we want to know, hey, what is the asset beta? So then we can weigh the betas. So we can take the asset beta, the equity beta times equity to value, debt beta times debt to value, and so for that we need what is the debt to value, what is the equity to value. So then I went to the annual report, Netflix's annual report, looked at the balance sheet, and the balance sheet showed that the total long-term debt was about $6.5 billion. So for this, let's assume that the beta of debt for Netflix is 0. So given their market cap, so the value of the total value of their equity, so the market value of their equity, I think this is fairly reasonable. So in practice, beta for debt will be non-zero because otherwise it would be completely risk-free. But here I don't think it will be all that high given how much bigger the market capitalization is compared to the debt value. So it should not be too far off. So now we can estimate the asset beta, and then the asset beta is 0.937. Great. Then again, let's go to Mentimeter, and there I'm going to ask you, hey, given that we know that the beta of the assets is 0.93, we have risk-free rate, we have a market risk premium, what are Spotify's company cost of capital? I'll give you a moment to think about it and pause me. And indeed, it's going to be 7.79%. So how does this work? Well, we simply fill in the values in the capital asset pricing model. So this is approximately the company cost of capital that you would expect for Spotify. So now we have return on the assets. We have so we still need the cash flows here, and we need the growth rate. So for the cash flows, let's go to the cash flow statement for Spotify, and if we then look at the cash flows from operating activities and investing activities, Then for the first quarter, we find that's approximately 220 or so 223, I think. So I multiply that by 4, gives us an estimate for what the cash flows would be for the next year. Note that this is very, very quick and dirty. So normally I would more focus on, so the free cash flows is typically estimated as EBIT, 1 minus T, plus depreciation, minus capital expenditures, and minus changes in net working capital. And so more or less cash flows from operating activities plus cash flows from investing activities, but slightly different. So what I'm doing here is very, very quick and dirty. It's more of an illustration of, hey, what can you do? How do people do this in practice, rather than really going into the nitty-gritty of it. So don't do it. Don't do this at home. This is more like a fun exercise. So those are the cash flows. What about the growth rate? Well, let's what can we do for the growth rate? Well, we can do a couple of things, but for now, let's simply look at an OECD report for what the world economy is going to do, and then assume that, hey, Spotify is going to grow approximately with the world economy as a whole. This OECD report here shows that in 2018 they expected world economy to grow by 3.9%. So let's simply put that in. So here we have this cash flow that we just estimated, the return on assets that we estimated, and here the growth rate that we estimated. And then this gives us approximately the total asset value for Spotify, which is great. Of course, Spotify also has liabilities. So if we then subtract the liabilities from the valuation of our assets, then we get an equity value of about 19 billion or so, and at 179 million shares outstanding, that is share price of, well, approximately $111. So that's fine and dandy. We can see how well did we do. Well, if we then look at what the share price actually did, so they opened at a certain price, but they also had this reference price. So this reference price, that is what the investment banks estimated, hey, this should be a pretty good price to set for Spotify's shares. So this is higher than we estimated, but I don't think we're too far off, especially given the speed with which we did calculation and the back of the envelope nature of what we estimated. I think we actually did pretty well. So I can promise you that the investment bankers over at Morgan Stanley, or whoever exactly valued this, did approximately what we did. Of course, a little bit more intricate with more steps, differing growth rates, and maybe a bit more comparables for the beta, but more or less this is it. One thing we can think about is, hey, why is the value by the investors so much higher than what we did? And for that, let's again go to Mentimeter. So we made a couple of assumptions. If we change the assumptions, which one would lead to a higher valuation of Spotify? Give you a moment to pause me and think about it. And here it's the growth rate of Spotify's business should be higher than the OECD economy, right? So Spotify is, well, it's maturing, but it's still growing quite a bit. So you can assume that it will grow faster than the economy as a whole. So these other reasons are also good reasons to change our valuation, but let's say a longer horizon of risk-free treasury rates would lead to a higher discount rate, affects the value negatively. A higher beta would also affect the valuation negatively. Higher beta should also affect the valuation negatively, and lower cash flows would also affect the valuation negatively. So here only C leads to a higher valuation. So this is to show you, hey, how do we use this stuff in practice? How is this useful for all the stuff that we've learned? And if you're interested in this stuff, continue doing more finance, and in your masters, make sure that you're looking for valuation courses. There's also very good valuation courses online. If you're interested in that stuff, I'll happily show you one that is that's very elaborate and that is excellent. So for now, I'm off. I'll be back with a small bit on factor models, so which kind of improve on the capital asset pricing model, or well, improve. And I'll be back for that. See you.